Okay, I'm just
Yeah,
gonna
you can.
assume that's a yes. Okay, so this is my presentation for today. So what is an option? Option contract is a legal agreement between a property owner and another party. Sometimes, often there's an intermediary involved, the market maker, that grants the latter the right to purchase the property at a specified price and within a specified period of time. A call option gives the buyer, the owner of the contract, the right, not the obligation to purchase the property at a given price. Options are typically settled by cash delivery of what the underlying is worth on the date or by physical delivery of the asset. So an example of that would be delivery of like corn or barrels of oil or whatever. The underlying would be the the asset like oil, corn, stocks, whatever. Buyers typically own contracts that settle by cash, as it can be quite difficult to store physical assets. The presentation will be discussing the portfolio approach of the binomial tree pricing model for options. Black-Scholes model was developed before the binomial tree, but typically people learn the binomial tree first as it's just easier, maybe a bit more intuitive. The binomial tree model is nicer for flexibility as it can handle a variety of conditions such as dividends, American versus European options, although the binomial model is slower than the Black-Scholes model. And initially, the assumptions made in this model seem quite unrealistic, but as it develops, it does get more realistic with central tendency theory and such. And the first step in this is going to be drawing the possible pathways. But yeah, so you draw the possible pathways of the asset and then you present value the cash flows of an option. So this is pretty standard with pricing. We're just saying what are these cash flows, future cash flows going to be worth today, right? So just sort of like a rundown of some basic finance math, right? Simple and compound interest. We're talking about like compound interest would apply to these, right? So the future value of something. The way we find a present value first, we're like, what's the future value of, an investment today? Here's the present value. So we did like 10,000, multiply it by, 1 plus 5%. So, like whatever, 1.05, and then n, the exponent there, would be the number of years or time that the cash flows, the interest is compounding, right? And then to rearrange, right? To rearrange, we would do this, and that would be the money today, right? So the cash flows divided by the 1 plus the interest rate to the exponent of the time, usually in years, where there's compounding of the interest. This is actually why stock markets and other markets are forward looking, right? All right. So with the binomial model, as I said, the first step is drawing your possible pathways, right? So it's important to note the first assumption, no arbitrage is freely available to impact the pricing. Second assumption, the assumption that with certainty there are two possible price outcomes for the underlying and at some point in the future and can't be another price. This initially seems like ridiculous, but eventually becomes reasonable, as I said, as the model develops. So say the underlying stock is trading at $50 today, and at the end of the month, it will be either trading at $70 or $30. Okay? In the case that the stock is trading at $70, the exercise price of the stock is still $50. We're just saying this is trading at the money, right? Trading at the money today, meaning there's no profit or loss. And then 1 month from today, you can exercise it, and in the upside economic scenario, exercise and get $20. In the downside, it expires worthless because you wouldn't want to exercise a option for $50 of that stock if it's trading at $30, right? Okay, so now to add to the theory, we want to set up a portfolio with some amount of the underlying and some amount of the derivative. That allows us to know the value of the portfolio at expiration. So to do this, the upside and the downside for the portfolio will have the exact same payoff, i.e. a riskless return. This would then be a risk-free portfolio, and if it's risk-free, we can then just calculate the risk-free portfolio by discounting the cash flow by the risk-free rate, right? So delta is, where you see delta is just going to represent some amount of, S is going to represent the underlying price in this scenario, so the underlying price of the stock. C is going to be the value of the call option. Okay. So to work out some amounts of the underlying that we can hold in either scenario, we make these two portfolios in the upside and downside economic scenarios equal to each other, and then we solve for delta. You then get two riskless portfolios because both have a predetermined payout. And this is how you would solve for delta. Well, this isn't really how you'd solve for delta, but when you solve this here, you get 0.5. So you would have 0.5 of the stock minus the call option. So let's see here, solving for that, so we get there. And in either scenario, the return will be $15. And then you would present value that for today, like so. Now, this is just kind of looks like a fancier way, but it's essentially the same way as if we just did the divide sign, right, by the percentage and to the exponent of n, right? And that would give you the value of the call option today. So it would be worth $10.06. All right, and this here is what would be next to the model. It's called the risk neutral binomial valuation, which we can do after the portfolio approach. And the risk neutral evaluation I personally like more. The method is mathematically identical in terms of logic, but this valuation relies on you initially create the portfolio instruments having a level of dependency on each other. Then if we know that the underlying and volatility of the underlying, we can then price options on the underlying. And if the underlying's value is fair, then we can value the derivative based off of that. So F would be the value of the derivative. P is considered a risk neutral probability of an up movement,
but I don't think you've acted on it.
which is pretty
Yeah.
similar to probability. You can just think of them for all intents and purposes as the
You
same.
get like 2 or
And then
3.
1 minus P would be the probability of a down movement. Technically the risk neutral probability, but again, for all intents and purposes, it's just the same.
Okay,
So
yeah.
the formula is just saying to multiply the probability of an
No, I'll
up
probably
event
go anyway. Even
by
if they
the
don't
payout
officially
of
affect me,
the down event, and then you
The
would,
amendment basing
multiply the
on
probability of an up
basically
event by the
11,
payout of that scenario,
11,
then you multiply the probability of the down event by the payout of that scenario, and then you add them
like
up
plus
and
Coleman,
value them.
accessible by train
Yes.
for walking.
And that's all I have for today. So
Even
thank you
if
for the
there's no
presentation.
official legends there, then
Sorry
I
it
just
didn't have any
or no
AI
legends.
generated art. It
That's
wasn't
not
pretty like
what.
last time.
Yeah, yeah. Bye.